Well, it's been over 700 days since we've seen more than a 10% correction in the market. And some of the stocks which have benefited the most from that run-up have been in the tech sector, which brings our next guest to our table as we have some questions about what his outlook is for that said sector. Josh Spencer is portfolio manager at T. Rowe Price, where he manages the global tech fund and also manages the TD Science and Technology Fund. It's great to have you here.
Thanks for having me.
I want to start off with valuations. As I mentioned, I mean, I don't think I have to tell anybody the markets have been doing fairly well in the past little while. How tough is it for you as a technology portfolio manager to find an attractive entry point, not paying too much for a stock right now?
Well, that's the big question in the market now. It's much, much harder than it was a year ago, 2 years ago. You get periodic dislocations when you find an entry point. But as you mentioned, the market's been on a strong run and it's been very lockstep. So there haven't been that many chances to buy the things that we want to buy. What we want are durable growth companies. You know, we may find a shot here or there, but lately it's been much tougher.
So what do you do?
Well, good question. What we do is we actually find those companies who can compound value over a longer term horizon.
What do you mean by compound value?
Well, what I mean is they can grow earnings not just this year, but the year after, the year after. And so when you think, well, nothing's so attractive today, but if I buy it today and I get the benefit of that earnings growth 2 years out and 3 years out, over time, we can make money for our shareholders that way.
So not a hot flash in the pan, like I'm thinking some games that are attached to Facebook, but something that has just, it has a continued growth outlook in the long term.
Something with staying power,
yeah.
Great cash flow, recurring revenue, these fantastic business models. And though you think of tech as the home of flash in the pans, we also have some very durable companies in tech as well.
I know that you and I were speaking earlier today, and I thought one of the things that was interesting is we tend to think of technology being, you know, social media or all the sexy things that you know, our new gadgets. But you know, technology is very important in a lot of, I'll say, primary industries that we don't even think about.
So true. For example, when you think about security and the challenges that we may have there, you know, we've seen the data breaches at big retailers. I was with the CEO of a small security company, Proofpoint. He spoke about how his product was being used in a hog farming outfit down in Arkansas.
How?
Well, despite the fact that it seems like a low-tech industry, it's actually become very sophisticated, and people are trying to break into this company's systems and see how they manage their livestock. And so they want to protect on the front end against that kind of data loss. These are trade secrets.
So what happened? Did this company come in and then provide that? Or
well, it's funny because the CEO said, well, I was in Arkansas. Who else am I going to see in Arkansas? And then he saw he had a full day of meetings with some of these other companies, mostly in agriculture and farming. And you know, he didn't expect it. But when he described the product and what it was capable of, the company really needed it. And they had it installed within a week because it's a cloud-based system, so it could be installed very quickly. Once a product like that is installed and it's sold on a subscription basis, it's not coming out. So now Proofpoint, this small security company, has a stream of revenue that will be lasting on an ongoing basis.
It's interesting when you look out of the landscape of equities right now, because I know you deal with more than just tech, but you also deal with tech as well. Does the story look different for you in terms of the U.S. equity outlook versus the U.S. technology equity outlook, or just technology, forget U.S.?
Yeah, it does and it doesn't. So when I think about broad technology, and I said I think the sweet spot is these durable growth companies, I think the same is true in the broad equity landscape. When you look around the market, I don't see a lot of areas that haven't been picked over and looked at. I mean, we're 5 years into a stock market recovery, so people have kind of turned over a lot of rocks at this point. And I think within tech, you focus on durable growth, and in the broad market, the same is true. It just happens that tech is blessed with some very good companies with great cash generation.
You made a pretty good call. I was taking a look back in the spring. You saw some, at the time, high flyers like Amazon, also Tesla pull back. I think you're on TV saying that it's time to buy. These are interesting ones. So, and I think you made a shift out of some of the older, I'll say, you know, more well-known names like Intel, Oracle, Microsoft, into the Amazons, the Baidus, the Tesla, the LinkedIn. Why did you do that? I mean, it was a good call, so that was good. But why? What prompted you to do that then?
Well, as a fund manager and a technology enthusiast, you always have a wish list of companies that you would like to own or that you would like to invest in. And we spend time with companies across the tech landscape. So think about Tesla. We visited their facility a number of times, met with the management. We love the product. We think they're revolutionizing things. But the stock was very expensive. Kind of rewind the clock when they had a number of fires in their cars and sentiment had turned negative. And then the market started to have some issues and the high flyers fell out of bed a little bit. That was our chance to buy Tesla. We'd had our eye on the company, and so we decided to buy then. The same is true with Amazon, which went through a similar phase earlier this year around some pricing pressure that Google had instituted in their cloud computing business. And what's interesting is when you get these pullbacks, if you've done the work up front, it makes it easier to step in and buy at that time, when otherwise you might feel a little bit squeamish.
Let's talk about some of the ones you've done the work out front on. These are things or equities you're holding right now. Amazon, as you've mentioned. Why do you like Amazon so much?
I couldn't be more excited about Amazon. They have two fantastic businesses. On the one hand, the retail business that we all know and love, and there, although it looks like they're not making a lot of money, I think they're making a lot, and they're just reinvesting it in fulfillment centers and strengthening the moat around their business. I've seen some work on their fulfillment centers. The one that they've built in California, it has 8 miles of automated conveyor belts within the facility. No one else can recreate that. So that is a very durable business. And around the world, in Japan, if you order a product in the morning, Amazon can have it to you by 5 p.m. the same day. And then on the other side, they have a cloud computing business where because of all the technology that they instituted to build this powerful retail business and the data that goes behind it, they decided, well, we're doing that for ourselves. We should do that for other companies. And now Amazon's become a leader in outsourced IT, where they can actually run the entire IT infrastructure for mainstream companies. They even won the contract to build a cloud for the CIA at the expense of IBM.
Another share or other equity like right now we have time for is Priceline. I always think of William Shatner when I see this one, but is that the reason why you like Priceline?
I do too. I always think of William Shatner, but what's interesting is that's actually a very small portion of the business. The company was built on a completely different brand known as Bookings.com, which is dominant in the European hotel market and has broadened around the world as well. The hotel market is a lot more fragmented in Europe and other parts of the world, and so as Priceline or Booking.com has gotten these hotels to sign up onto their platform, it has a bit of a flywheel effect where small hotels are listed, so consumers go there to find them. You have issues around language translation and currency, and Priceline or Booking.com makes that easy. And that's the type of business where year after year it gets better and it gets bigger.
I've only got about 30 seconds. ASML.
Yes.
Why are they in your top holdings?
Well, they are a wonderful company. They make what's called lithography equipment for the semiconductor industry, the tiny little features that get printed on chips. They are responsible for all that. What's great about them is they're the only company in the world that can do it. So a new machine from ASML costs approximately 75 million euros. And they're entering a new cycle with a machine called EUV, extreme ultraviolet radiation. Those machines are going to be rolling out over the next few years, and as that happens, I think it's going to be a big boon for ASML's earnings.
Great to have you here, Josh. Thanks so much.
It's nice to be here.
That's Josh Spencer. He is portfolio manager with T. Rowe Price, where he manages the Global Technology Fund and TD's Science and Technology Fund.